Hello and welcome to our presentation on the company known as Pacific Brands Limited. My name is Paul and I'm here with fellow group members Nelson and Anthony, who will be speaking shortly. Pacific Brands is a very large Australian company that owns many iconic brands such as Bonds, King G, Sheridan, and lots of other brands in the clothing and footwear industry. The entity's principal activities during the course of the 2012 financial year were the sourcing, marketing, wholesaling and retailing of predominantly consumer products in the underwear, socks, hosiery, intimate apparel, corporate uniforms, workwear, footwear, bed linen, bedding accessories, bedding, foams, carpet underlay, apparel and sporting goods markets as outlined in the Director's Report. Pacific Brands manufactures and distributes products in three major operating segments. These are underwear, which accounted for 32.7% of 2012 sales, workwear, which accounted for 29.4% of 2012 sales, homewares, footwear and outerwear, which accounted for 37.9% of 2012 sales. The amount of consolidated profit after tax attributable to the shareholders of Pacific Brands for the 2012 year is $450,650,000. CEO is John Polyers. However, he only assumed this role in September 2012. Sue Morford stood down as CEO on August the 22nd, and therefore she was CEO in the financial period ending 30th of June 2012. According to the 2012 remuneration report, Sue Morford's salary was $1,623,966. This consisted of a fixed salary of $1,362,526. I'll now pass it over to Nelson.
The auditors of the financial statements for the year ended 30 June 2012 were KPMG Australia. The audit fees were $1,108,000 for the period. Question 5. The entity has 27 subsidiaries that are all 100% controlled. 9 of these are foreign subsidiaries. The entity has also 7 subsidiaries that are 50% controlled, and these are all foreign. The consolidated entity has a 49% interest in the ordinary shares of Pacific Brands UAE, which is a foreign entity. As there is no other information disclosed, we are working under the assumption that this 49% interest does not equate in control, and therefore the entity is regarded as an associate, as a consolidated entity has significant influence. The consolidated entity does not have any interest in jointly controlled operations and assets. The value of consolidated goodwill for the 2012 financial year is $171,696,000. The consolidated entity has 4 cash generating units. These are 1. Underwear, 2. Workwear, 3. Homewares, 4. Footwear, outerwear and sport. Pacific Brands recorded an impairment of goodwill for the 2012 financial year of $503,816,000. Pacific Brands recognised impairment losses with respect to underwear was $388.7 million for a half year figure, homewares of $63 million, and workwear of $51 million. The consolidated entity has formed a tax consolidation group since April of 2004. Therefore, the entire consolidated entity is taxed as a single entity. Pacific Brands Limited, as a parent, is the head entity. Current tax expense and income, deferred tax liabilities and deferred tax assets arising from temporary differences of the parent and subsidiaries are recognised in their own separate financial statements using the standalone taxpayer method consistent with interpretations 1052 tax consolidation accounting. I'll now pass it on to Anthony.
Pacific Brands has made segment disclosure. There are 3 operating segments: underwear, workwear, homewares, footwear and outerwear. The basis of disclosure is measured on segment earnings before interest, tax, amortization, which are other intangible assets only, and significant items, which is EBITDA. On screen now is the group corporate structure diagram for our consolidated entity. And Pacific Brands Limited is the parent company, and Pacific Brands has 100% control and ownership of 27 subsidiaries, and these include both subsidiaries at Australia and overseas. The parent also has a 50% interest and control of 7 subsidiaries, and these are all located in Malaysia. However, it is important to note that these subsidiaries, as part of the Restonic Group, are currently being held for sale, and this is included in Note 16 of the financial statements and report for the year ended 30th of June 2012. And finally, the parent has a 49% interest in Pacific Brands United Arab Emirates, and as a limited disclosure in the statements, we are under the assumption that this is only an associate, as control has not been established and only significant influence has. The consolidated financial statements have been prepared on the historical cost basis, except for loans and receivables that are measured at amortized cost. Derivative financial instruments that are stated at their fair value and assets held for sale are remeasured to fair value. Interest in jointly controlled entities are accounted for using the equity method, where they are initially recognised at cost and adjusted thereafter for the post-acquisition change in the investor's share of net assets of the investee. Controlled entities are entities controlled by the company. Control exists when the company has the power, directly or indirectly, to govern the financial and operating policies of an entity so as to obtain benefits from its activities. In assessing control, potential voting rights that presently are exercisable or convertible are taken into account. The financial statements of controlled entities are included in these financial statements from the date that control commences until the date that control ceases. And this is in accordance with AASB 127, Consolidated and Separate Financial Statements. Intragroup balances and any unrealized gains and losses or revenues and expenses arising from intragroup transactions are eliminated in preparing the financial statements. And this is also in accordance with AASB 127, Consolidated and Separate Financial Statements. Business combinations are accounted for using the acquisition method as at the acquisition date, which is the date on which control is transferred to the consolidated entity. And this is in accordance with AASB 3, Business Combinations. For acquisitions on or after 1st of July 2009, the consolidated entity measures goodwill at the acquisition date as the fair value of the consideration transferred plus the recognized amount of any non-controlling interest in the acquisitions. If the business combination is achieved in stages, the fair value of the existing equity interest in the acquisition less the net recognized amount, which is generally fair value, of the identifiable assets acquired and liabilities assumed. Revenues are recognized at fair value of the consideration received, net of the amount of goods and services tax payable to the relevant taxation authority. And this is in accordance with AASB 118, Revenue. In terms of how these items have been accounted for in the parent entity accounts, we are limited to the information disclosed in Note 31 of the annual report for the year ended 30 June 2012. This note, unfortunately, discloses very little information that helps comment on this. However, it is almost certain this would be consistent with AASB 1024, Consolidated Accounts. For example, the accounting policies employed in the preparation and presentation of consolidated accounts shall be consistent. The policies employed by the parent entity and its subsidiaries in Pacific Brands Limited are therefore consistent. A dissimilar accounting policy that necessitates an adjustment in preparing consolidated accounts include the use by an overseas subsidiary of policies that are not permitted by the standards imposed by the Australian Accounting Standards Board. Therefore, the foreign subsidiaries held by the consolidated entity would have had their accounting policies adjusted in order to comply with AASB 1024.